Good evening, I'm Ed Grant. Welcome to Ask the Specialists. Tonight, we ask the CPAs on CMU Public Television. Tonight we're live in the studio with experts to answer your questions regarding a wide range of personal financial issues. 3 ways to contact us are in the next half hour are listed on below your screen and will remain there for the entire length of the program. So call us, message us on Facebook or Twitter. The tax filing deadlines are fast approaching, and now is the time to get those last-minute tax questions answered, and also to start planning for next year's tax returns and things that you can do in 2014 to help that along. We have 2 experts with us tonight to help discuss some of those issues. And first off, I'd like to turn to Keith Frame, who has come to us from Robert F. Murray and Company, located in Mount Pleasant and in Midland. Hi, Keith. Thanks for coming in and
thanks, Ed.
Being with us.
Happy
we appreciate that. Maybe you can talk a little bit about the types of things that you're doing in your practice these days in order to give the viewers an idea of the types of questions they may want to raise with you.
Well, for us, it's the heat of tax season, of course, and we're very busy working on business returns, business financial statements, and we work with a lot of owners of these businesses. Of course, we prepare their personal returns, and so we're very busy with that right now.
Okay, great. Well, thanks for being here. And Ryan Bogue from Bogue, Waibenga and Bradley in Mount Pleasant. Thank you for coming with us, Ryan. We appreciate you taking time during this busy part of your work schedule to spend a few minutes in answering questions.
Well,
Maybe you can give us an idea about the types of things that are part of your normal work routine.
Yeah, as Keith said, we're in the middle of tax season. We do same types of stuff. We're mostly personal and business tax returns this time of year, business financial statements.
Okay, great. All right, well, thanks for everyone. Now, once again, you can get on the phone, get online with Facebook and Twitter, however you'd like to get those questions in. We're here to answer those questions during the next half hour. Let's talk a little bit about some of the the limits on how much I can give my children before there's any tax implications in terms of a gift or in terms of transferring assets. Either one of you want to take a whack at that question?
Well, the gifting limit in 2014 is $14,000, I believe, per donee, per individual. So you can give up to $14,000 to any donee you want without reporting that or filing a gift tax return. If you give more than that, you have to file a gift tax return. You can use a unified credit to not pay any tax. Basically, I believe the exemption for gifts is the same as the estate tax exemption at $5.2 million this year. It is indexed for inflation. It changes a little bit every year, so I'm not quite sure what the limit is this year.
Okay. Here's a business tax question. If we're starting a small business and are considering whether to organize as a partnership or a corporation, or even a sole proprietorship for that matter, what are some of the advantages or disadvantages of the different forms of business organization? Ryan?
Well, generally, we see mostly S corporations or partnerships when we set something like this up.
Okay.
The disadvantage of, I guess I could call it a disadvantage of a S corporation would be that the owners are responsible for filing payroll tax forms and doing payroll out of there for themselves. A lot of business owners are too busy to do that kind of stuff, so sometimes that gets neglected. Partnership stuff, you don't really have to do that for, you can do that for an owner, so.
Okay.
One of the important things about forming an entity, though, is not necessarily tax related. It's about limited liability. I mean, you want a corporation or an LLC if you're going to be doing business in a risky activity. So that's kind of decision one, and then you kind of look at the tax situation, and there's lots of things we can do with different entities.
Okay, great. Let's turn to another one that seems to be coming up more regularly, and that is the alternative minimum tax. Here's a question. For the second year in a row, I'll have to pay the alternative minimum tax. What can I do to reduce the possibility or the probability of having to pay it at my current levels in future years?
Make less money.
Make less money?
There's not much you can do to avoid it. It's an alternative, as it's named, calculation that basically takes away certain deductions and exemptions and multiplies it by a flat rate. And you really can't escape it. If you fall into it, there's not much you can do.
Okay, here's a question from Maple Rapids. With a Roth IRA, can you take money without penalty? And how much can you contribute to a Roth per year?
You can take money without penalty up to your basis.
Up to the basis.
Up to your basis in the Roth IRA.
Which is the amount invested?
The amount invested,
set
yes.
aside?
Yep.
One of the nice things about a Roth is it's the same limits as a regular IRA. You have to have earned income like a regular IRA. But when you put the money in, you basically can take out what you've put in without penalty, without tax. The earnings, of course, are taxable if you take those out.
Okay, and a question from Traverse City. This individual is helping their 25-year-old daughter with school expenses, rent, school, tuition, health insurance. They file, apparently the parent and the child do file separate returns, but can the parent put her down as some type of a deduction or deductible? Can they be a dependent?
Well, they can. There's a number of tests, and when you get past the normal college age of 19 to 23, there's some hurdles, and one of them being the income test, which is, I believe, if the potential dependent makes more than the exemption, which is $3,900, $3,950 this year.
Okay.
Then they cannot be claimed as a dependent. When they're in the normal college age ranges from 19 to 23, they can have income in excess of that and still be claimed as a dependent. So,
it doesn't matter that the parent is still providing a majority?
Doesn't matter once you're past that age 20, well, I think it's actually past age 22, or 23, 23, I think you're right, 23.
Okay, here's a question, maybe dealing with some of the more retired folks or folks with a limited source of income. If a person's total income is so low that they owe no income tax, and all of what they earn is from interest and Social Security amounts received, should they file a return anyway? Do they need to?
Typically not. Okay. Retirees are not typically eligible for refundable credits and things like that. So, but you have to look at the state filing requirements as well. They're typically a little bit lower. So if you don't owe a federal tax, you might have a state tax. But again, there's subtractions for senior citizens that typically mean that they're not going to need to file.
What about the fact, does it depend at all on how much interest income they've got?
Up to, if they're not going to owe a tax, I don't believe it makes any difference what type of income it is, up to the exemption, whatever the 10, 12, 14,000, somewhere around there.
Okay, here's a question which I don't follow, but maybe you can shed some light on. And this, they're talking about a Michigan state tax. Apparently, it says how much can an individual deduct from their pension? And it alluded to something about in previous year it was 47,000.
Oh, okay. They're referring to the change in the Michigan income tax law regarding pension subtractions, which, if you recall, historically, pensions have been subtractable up to a very large limit in Michigan. Right. That was changed last year with part of Governor Snyder's revamping of the code. And that has changed, and it's rather complicated. I can't even explain it very well because depends on your age, the year you were born, what your spouse's age is. Bottom line is, any senior citizen that had been subtracting retirement benefits still is. The limit is a little bit lower, but for the most part, it hasn't affected anybody at all that I've seen.
Okay. Let me ask.
It will in the future.
Okay. If an individual owns their own business, and I'm presuming they may be doing a lot of their own bookwork, how often should they see their accountant, or for what would be the normal reasons they would go see their accountant, and how frequently might that be necessary? Brian?
Definitely at least once before the end of the year. We like to see people come in October, November, and we can do a little tax planning for them and kind of look at their situation and see where they're at and what their tax burden might be come the following year.
There's only so much we can do after the year, after the end.
Right.
Right. So planning in advance for year end, and obviously also then helping them get ready in terms of what might happen the following year.
I mean, obviously, there's more to understanding finances and doing taxes. I mean, you need to, if you've got different lines of business, you need to know where you're making your money, where you can cut your costs. You know, accounting has a lot of value besides just doing tax returns.
Let's talk for a little bit about the normal deductions that appear for individuals and so on and so forth, mortgage interest and so on and so forth. Have we seen any change in terms of any of those deductibility rules on the federal returns in recent times, or that are affecting people that may not have been treated that way previously?
Well, there's been a number of changes. Medical expenses now are only deductible to the extent they exceed 10% of your income. It had been
So it's
7.5% for many years. I think the biggest thing that we're seeing is the overall limit on itemized deductions for higher income earners. You know, one of the things that they had bandied about for quite some time was limiting charitable contributions, but that was, you know, politically it was not going to fly. But yet they've basically put a formula to limit itemized deductions, which include charitable contributions. So now people with high incomes don't get much of a value with charitable contributions that they used to get.
Okay, all right. Here's a question. They're asking us to talk a little bit about self-directed IRAs. Do we know what we're talking about in terms of the self-directed ones?
Most IRAs are self-directed.
They are.
I mean,
so you might want to talk a
decide
little about
what
the different
custodian.
IRA options that folks have out there. We can talk about so that they have an idea. We alluded to the Roth IRA and so
Well, you know, one of the things that I see regularly is people come in and they want to invest in an IRA, and they don't really understand that the IRA is nothing but an account name that defers tax, basically. So it's nothing other than any other brokerage account or bank account. Typically, you put money in that account. You can invest it in anything you want within limits. There are, of course, some restrictions. But most IRAs are self-directed depending on what custodian you're using, whether a brokerage company or bank.
So when we see the public notices, the advertisements and so on after year end, talking about it's not too late to put funds into an IRA, which type of IRAs are they talking about, and how would an individual usually go about that, making the decisions, which way to go on that?
Generally, they're talking about traditional or Roth IRAs.
Okay.
In that case, you have until April 15th to make those contributions.
For the preceding year?
For the preceding year,
Okay.
correct, yep.
Okay.
How to make a determination.
And whether you qualify to make a contribution, it's rather complicated.
Okay. So those
There's
are the
income
times.
limits, you have to
Right.
have earned income, whether your spouse is a participant in a retirement plan affects whether you can contribute. The amount of your income, there's a number of limitations.
Yeah.
So obviously, you know, somebody like us can help people with that kind of decision.
As we looked at 2014, what are some of the changes in either changes in terms of tax rates or tax regulations that are affecting people during the current year that will be imposed coming, you know, on filing the returns this time next year?
Well, I
Any
would
ideas?
guess the Obamacare penalties would be number one on the list, and
Okay.
and how is that going to look on the return? I have no idea. I've not heard any
There's not been any guidance at all in
discussion of
terms
that.
of-
This year, the penalty for not having health insurance is, I believe, the greater of 1% of your income, or $95. So
Yep.
how that's computed and what form that's going to be on is yet to come.
So, and in order for that to kick in, what has to take place? I mean, for them not to have health insurance. Maybe we want to just review the timelines and so on.
Well,
and all that.
it's an incredibly complex topic, as I think everybody knows. Not many people know how all this is going to shake out, but as I understand it, you have to have health insurance by March 31st, within a week here, and that's when the penalties start. And it's a per month penalty. I'm not exactly sure how it's going to be computed.
But these are individual deadlines. On
This is the
individuals.
part of the individual mandate in Obamacare that requires everybody to have health insurance.
Okay. In terms of the business side of the world, okay, is there anything you'd like to share with folks in terms of maybe as a small employer or employer under 50 or versus
Well,
over 50 employees?
it's been a big issue amongst our clients. You know, they've just relaxed the mandate, the large employer mandate. They required businesses with more than 50 employees to provide health insurance, and that's been a big relief for our clients. And it's been a very difficult issue to deal with, and costs are going up, and changes are going to be made.
Okay, let's say we've got a high schooler, 16 years old, let's say, who's working. Do they have to themselves file their tax returns, or do their parents have to do it for them? Since they're a minor. Is there anything in terms of that goes along with that in terms of them filing their own return versus someone else doing it on their behalf?
Well, it needs to be done if they are, you know, there is, minors can have an income tax. They get an exemption of their earned income plus a certain amount. So
Right.
depending on their income, they may very well have a tax. But typically, minors have tax withheld, and they're typically filing the returns to get the
return.
refunds.
Yeah, get the refund. Yep. Okay. And the dollar amount of that income, anyone know off the top of their head, it's probably 4,000 something or somewhere in that ballpark.
I can't keep
it's
track
in
of
the-
any of
it's
these
in the
limits. I have
thousands.
computers that take care of this kind
Really?
of stuff.
Really? You should have brought one with
But
you.
again, they're probably going to be looking at a refund, so it's worth. It's probably worth filing for them.
Okay. Here's a question dealing with, and this was something that came over the newswire, talking about the amount of unclaimed tax refunds that are sitting at the IRS.
I saw that news story was just this week, 793 million or something
Right,
like that.
and the
yeah.
issue is you know, why would, you know, how could that happen? But some of those were, I mean, the average return, the average amount withheld was in $500 or $600 that had not been refunded. So, is there any way that folks can, if they think they fall in that category, that they would they just normally contact a regional IRS office, or?
You know, that's a good question. I mean, I don't believe there's any type of refund claims available other than filing a tax return.
Okay.
There's no other way to get that money. So again, you
they'd
need to
have
understand
file-
where your
they'd
income
have to
and
file some type of a amended return for one of the last.
well,
three.
it's more than likely original returns, like these minors
is.
that you talk
Okay.
about that have a $1,000 W-2 with $100 of withholding that they didn't file a return on.
Okay. What about paying taxes on your Roth IRA? If I'm presuming that this is if you know, took the amount out, you're using after-tax dollars. Is that correct? For a Roth IRA.
That's right.
Yes, sir.
So this is what we talked about before, with the basis would be the amount that you put in. So that part would come out, and the rest of it, any interest or whatever, would come out as normal income,
Well,
regular income.
that's the beauty of the Roth IRA is that you put money in after taxes, it grows tax-free. You pull that out when you're over 59 and a half, there is no tax on the growth, as opposed to a regular IRA, which you deduct going in. So when you pull that out after age 59 and a half, it's all taxable.
Okay.
The only tax on a Roth IRA would be if you pulled it out early and you pulled out
Okay.
your gain would be taxable to you, and you'd pay penalty on the gain
Yeah,
also.
which is going to be the interest or whatever form of return you've got
Yeah.
that invested in.
That's correct.
You want to talk a little bit about the different types of annuities that some of your clients or that you've seen are popular with individuals now as they maybe are 5, 10, 15 years out from retirement age trying to invest excess savings? Is there different types of alternative investments you're seing folks enter into these days?
You know, that's just not an area that we get into too often. We're not real fans of annuities, generally speaking, and
Okay.
we're dealing with tax-deferred vehicles like IRAs and
Sure.
retirement plans. As it is, we don't really need to wrap them up in another vehicle.
Okay. Here's a question that came in online. The mortgage and the tax impact on the deductibility of interest. Okay, I think what they're referring to here is the limits that may exist on the deductibility of interest on individual tax returns. different types of mortgage interest?
Well, there are limits. Most people don't see them. You can only deduct up to $1 million of the purchase price of a house, so a mortgage up to $1 million, and I think you can have another 100,000 of home equity line on that. So, I mean, there's a limit there. Most individuals won't see that limitation.
But other forms of interest, you may want to speak about the types of
personal
interest that
and the
people
like.
have that are not deductible. Brian?
Auto interest.
Auto? Credit cards?
Credit card interest, correct, yep.
Okay. And there is a limit on home equity lines in terms of, regardless of how much your primary loan is, right?
If you use your home equity line for other than home improvements, there is, I believe that's a $100,000 limitation too,
Yep.
in terms of the amount borrowed.
Okay. Because that can come into play with a number of people, particularly with so-called cheap money that's out there. Folks may use the equity in their home for non-home purposes.
You know, we just don't see as much of that as we used to these days.
Okay.
You know, the way home prices went there for a while, it wasn't, people weren't cashing out, it wasn't happening for a while.
Right. I've seen it in a few cases, particularly with those folks that are, you know, have had a home for a long period of time, and they've got a rather low first mortgage on it, and they're looking to.
It used to be very popular.
Try to
It used to be very popular, but it just seems to have gone by. It was a sign of the times, I think.
The sign of the times is, but now things are starting to come back, so we can see what happens there. Someone that's invested in a 401k plan, a defined contribution plan, and has changed jobs, can they get the money out of that plan prior to retirement under any circumstances? Do you know, is there anything that we can think of that falls in that category?
Typically, they can keep the money in that plan, or they can roll it to the plan of the employer they're at now, or they can roll it to an IRA.
Okay.
But they can't get the money early. If they take the money early, they're subject to penalty and tax.
Okay. What about in terms of any way of getting the cash out, like hardship cases or anything like that?
There are hardship rules. You know, I'm not that familiar with all those rules. Typically, plan administrators are going to be more familiar with those types of things.
Some 401ks also allow you to take a loan from it, but I think you have to be active in the plan at the time.
Oh, you do? Okay.
I believe so.
Okay. Number of folks shortchange you guys and file their own returns electronically, okay? Is it safe to have it deposited straight to your bank account with routing information, or should you have it mailed to you as a check? Question from
We find direct deposit very convenient and very safe. It's fast, safe, and convenient.
Is there anything going on at the state level in terms of required electronic or refunds being made electronically that you know
We
of?
typically have all those direct deposited too.
Okay.
Yep.
Okay.
Yeah, we do too.
There's nothing driving it in terms of state regs that you know of, though.
Well, you know, we're
You do it
mandated
anyway.
to file federal returns electronically. I tell you the truth, I don't even know if we're mandated to file state
Okay.
returns. We just do because it's convenient and it works quite
It's
well.
just easier.
It's easier.
Okay. A senior on fixed income with Social Security, if their income is lower than $25,000, do they still have to file a return? I'm not quite certain where the $25,000 came from, but
Generally speaking, they're going to have a tax.
they're going to have a tax. Okay. If their income, I'm not sure whether or not the income is, you know, bottom line or.
Well,
know,
if you had $25,000 of income, let's say it's not Social Security income. I mean,
Okay.
you know, if they're married filing joint, they got a $14,000 standard deduction and a $7,900. They're going to have a few $1,000s of taxable
Right.
income. They're going to have a little tax.
Right. But the Social Security, that would be in terms of income other than Social Security.
Well, I said excluding that because there's special formulas involved with that income that we need computers to figure out.
You need computers. Yep, blame it on the computers, eh? But
There's
no,
a computation
crutch.
behind every
yeah,
line
it's the
now.
crutch.
I mean,
It's a good.
we couldn't even do these things without computers anymore.
How about an additional question here? This individual owns a rental home and also has a home that they homestead. But they want to sell the main house, their one that's been homesteaded, move into the rental, convert that to their permanent residence. will they have to pay any capital gains on moving it from a rental income producing property to their homestead, or is there any way to avoid that?
There's a recent change on that. I'm trying to remember how that works exactly, but there is, bottom line is what you want to do is you want to sell the house you're living in, presumably at a gain, not pay any tax on that because of the exclusion, move into the rental house, live in that for 2 of 5 years, and then you can sell that without paying tax on the gain. But there is some recent change on that I think there will be some pickup of some gain because of the depreciation on the rental property.
Okay.
Yeah.
So they would have to pick that up if they've depreciated the property, which
Exactly.
presumably they
Potentially.
would.
Potentially.
Potentially.
There is a
Potentially.
potential.
Okay. Here's a question from Mount Pleasant. How do I report $8,960 in net investment income? I'm not sure whether that's a tax or whether or not that's just the amount that they show as the income.
They might be
net
referring,
investment income.
They might be referring to, there's a new tax this year, part of Obamacare, a 3.8% tax on net
Okay.
investment income. That applies to people who have income in excess of $250,000, and there's a new form that basically takes numbers off the existing tax form and specific numbers that they consider to be investment income, goes through a separate calculation, comes up with a new tax, and it gets plopped on page 2 of the tax return. So that may be what this person's referring
Okay.
to.
And then another question here. As a homeowner, we talked a little bit about the deductibility of mortgage interest, deductibility of property taxes. Any limits on those in terms of deductibility to just a primary and secondary residence? Or is it one of those that we don't, that has no limit?
Property taxes of any type are
long as you pay
deductible.
them.
As long as you
long
got
as
to
you-
pay them
you
in
have
the
to pay
year,
them in
you're
the year.
deducting them.
Right. Okay. Well, I think that we're just about out of time now, and I want to thank you both. Thank you, Keith. Thank you, Ryan, for coming with us tonight and spending some time. We want to thank the phone operators who've volunteered their time, and thank you, the viewers out there who've chosen to tune in and watch the Ask the CPAs. Well, hopefully we can have you tune in again next week for next week's Ask the Program. And I'm Ed Grant, and thanks again. Good night.